to move on and welcome in our next guest on the show. We have Rahul Singh of Tata Mutual Fund now joining in. He is, of course, the CIO at Tata Asset Management. Rahul, good afternoon. Great to have you on the show. Thanks very much for being with us. So we're talking to you just after the conclusion of the third quarter earnings season. So first things first, tell us that at 20 times on the Nifty, looking at what you've seen from corporate commentary, from the numbers themselves, are earnings giving enough of a reason for this market to move higher?
Yeah, hi, good afternoon. I think the earnings have been by and large okay. It's the revenue growth or the top line growth which is not very good. It is still in single digits, although the profit growth has been, if you look at the top 500 companies, the profit growth has been in the range of 25% for the quarter, which is fairly healthy. But the revenue growth, as I said, has been single digit for a variety of reasons. So I think we need to watch out for any signs of further slowdown in consumption, or if there is a recovery. But otherwise, on the earnings front, after the result season, we haven't seen too much of earning changes at an aggregate level. Of course, each company, each sector is different, but at an aggregate level, we haven't seen too many of consensus estimate changes at the either at the Nifty level or the BSE 200 level, or even more.
So, what did you like the most during this earnings season, and what is it that you were not very happy with?
Well, I think there was a lot to like, of course, in terms of what we saw on the capital goods, as well as the continued momentum on the industrial side or the manufacturing side of the economy. Obviously, urban consumption, rural consumption continues to be slow, and in some cases gone even slower. Also, in terms of the financial services, there is still a lot of confusion in terms of the trade-off between growth and the NIMs. I think that trade-off might continue for another 1 or 2 quarters. But overall, I think while the earnings were okay for the financial services and the larger banks, I think the trade-off between growth and NIMs is what I think the market is still contending with, and whether that's a big enough risk or is just a small, short-term risk of 6 months. I think that is where the confusion was. But as I said, overall, I think the earnings reflected the phase of the economic cycle we are in, which is that for the first time, if you look at the last quarter's GDP growth rate data, first time the GFCF growth was more than the consumption growth, and that is essentially what is coming out in the earnings. So it's no real surprises there. And our own sense, talking to the various companies and looking at the data, is that this momentum is likely to continue the entire this year. And it might become a more stock-specific market from here on, because as I think the first question mentioned, that the overall valuations have gone to 20 times. So the return expectations from equities need to be toned down a little bit. But at the same time, there are opportunities to generate alpha. There would be, at an overall level, the large caps look more interesting from a risk-reward perspective, even though mid and small caps continue to do well. So those are the things one will have to keep in mind when we look at the portfolio from a 12 to 24 month perspective, and not just a 3-month perspective.
Okay, all right. Hi, Rahul. Good afternoon and good to see you in. Where are you placed with regard to this entire PSU re-rating that we have seen on various sectors? Do you think it's almost in the price? We were talking about PSU companies, the entire basket was available at around 15 lakh crore. That's moved to around 55 to 60 lakh crore. But the good news is PAT as well has moved. Net profit has moved up in the, almost the same manner. So where are you placed right now on PSUs? And also, if there is value, in which public sector units are there still value?
Right, a good question. Actually, the PSU rally, if you go back, it started almost 2 years back with the PSU banks, and gradually it spread to defense, where the fundamentals improved for a lot of the defense PSUs. Then it spread to power sector, where again the fundamentals improved, and finally it is moved on to oil and gas. So I would not like to paint everything with one brush. I think they have followed the fundamentals to a large extent. Of course, there will be that 10-20% pocket of PSUs which have which have belied all expectations in terms of the stock returns, and that we need to be careful in that segment of the PSUs, which is gotten a little bit carried away, a little bit ahead of itself. But by and large, if you look at the banks, I think the major part of re-rating is over. But can they sustain a 1% ROA this year also? I think the potential is good. Similarly, if you look at power sector, I think there has been a shift in the way the power sector was perceived in terms of coal being a bad word versus now where I think everyone is realizing that we need to be as much generating power from fossil fuels as much as from renewables. So there is a shift there, which I think is a long-term shift in the stance. On the defense side, I think the valuations have become little expensive, although the fundamentals have improved. And finally, moving to oil and gas, I think it's the most, it's obviously a tricky sector because the way the government plays a role in terms of pricing. But still, if you look at the PSU pack as a whole, I think the valuations for oil PSUs are probably the most reasonable, although they also carry more risk. So I think we are looking at PSUs on a more case-by-case approach and a sector-by-sector approach rather than painting it with one single brush.
Absolutely, that makes perfect sense because these are very different companies, very, very different sectors with their own individual dynamics. Rahul, stay on. We also want to talk to you about IT. That's one sector that you're neutral on, but just allow us to bring in our colleague Pavitra before we talk about your stance on IT, because she's been looking at all the Nvidia euphoria that's been going on out there and trying to make sense of what that has meant for Indian investors. I mean, people like you and I who invest through Indian mutual funds. So she's looking at the kind of MF exposure that exists, Indian MF exposure that exists with respect to both Nvidia and overall AI participants. So tell us more about this, Pavitra.
Thanks a lot for that. While the Nvidia stock has been absolutely unstoppable, right? It is up 64% this year, 240% if you look at the last 1 year, and around 490% over the last 3 years. So let's look at the Indian mutual fund exposure. Let me start off by telling you that it's not a lot. This is data compiled by ASMF and FISDIM Research. So the total Indian mutual fund holding in Nvidia is worth around 1,700 crore rupees. If you look at it at an AMC level, it is Motilal Oswal which has the highest exposure. It's around 440 crores like you can see on your screen. This is followed by Mirae at 280 crores, Franklin at 200 crores, you have Axis at 170 and Kotak at 143. There are a few more, but I'm just going through, the top 5 over here. What I want to point out is that, there is a clear passive in here. The non-broad-based passive exposure to Nvidia is around 980 crores. The 5 passive funds with the highest exposure are on your screen as well. So you have Motilal at the top. In fact, Motilal with both of their schemes together has around 430 crores of this 980 crores in terms of exposure to Nvidia. There's also 600 crores which comes in via broad-based passive funds. And this is where it gets very surprising. Active funds together have just under 130 crores in Nvidia. So much, much lower than what the passives have, just on account of tracking the index. And this is via only 2 schemes, the Axis Special Situation and the Axis growth opportunities as well. So for the massive stock surge that we've seen, Indian active fund managers have stayed out or perhaps missed out on this one.
Interesting one there, Pavitra. But tell us more about the active funds exposure to AI stocks, because, that's also the buzzword these days.
This is, I've decided to look at the other AI stocks, and this is what really stood out to me. The Nvidia stock is hugely under-owned by Indian active mutual funds and mutual funds that definitely like AI players, right? So I looked at only those stocks. Before I get to that, let me just take you through the 8 companies that are identified as making up the AI pack. You have Alphabet, Amazon, Advanced Micro, Nvidia, of course. The list is on your screen. Now, active funds with significant AI investment include the well-loved Parag Parikh FlexiCap Fund, the SBI Focused Equity Fund, SBI FlexiCap Fund, SBI Magnum Global Fund, and the ICICI Pru. These are the larger ones that I'm mentioning. Now, all of these funds have significant exposure to AI stocks, right? Parag Parikh holds Microsoft, Amazon, Alphabet, Facebook. So it has 4 of those stocks. SBI Focused Equity has a big chunk in Alphabet. Around 7% of their portfolio is in this one name. SBI FlexiCap Fund has both Alphabet and Microsoft. The Magnum Global Fund has exposure to Alphabet, again over 7%. They also hold Microsoft, and the ICICI Pru US Blue Chip also has exposure to Alphabet, Amazon, and Microsoft. Now, the common factor and the reason why I'm going through this long list is to show you that none of these funds that like AI feature Nvidia in their list. So they don't have AI in spite of the fact that they definitely like the AI theme.
All right, Pavitra, thank you very much. Interesting analysis there coming through with respect to how Indian asset managers are investing in some of this, the blue sky technologies out there, including AI. Rahul, so I'll make that our last question to you. As I said, I know that you folks are neutral on IT right now, but then there are, a lot of these new areas of opportunity. And, there are funds that are also taking global exposure. How are you looking at not just pure play IT services, but some of the other areas as well? Do you see anything, moving here, changing here?
Yeah, sure. I mean, although we are neutral to underweight on IT services in general in our, broader diversified funds. But if you look at our digital fund, which is, which is a very large fund, we have exposure to some of these emerging themes. More importantly, even within India. So we looked at, so for example, when the 2021 IPOs happened for the new age companies or the e-commerce companies, we by and large stayed away. But we have seen that these companies have also started focusing on profitability. They have a much more robust business model than what they had in 2021 when they IPO'd. So we have a fairly decent weightage in some of these companies in the Indian e-commerce or fintech or if you want to call it the new age space. So we are selectively looking at it, but again the call becomes very, very stock specific rather than looking at it as an asset class. We have to look at it now on a stock specific basis, and some of those companies do have a fairly robust business model now. And revenue model, and soon turning profitable as well.
Okay, so have an eye on a lot of these emerging technologies, maybe not AI, but a lot of the other payment technologies and whatnot, and consumer tech companies that we've seen list of late. Thank you very much, Rahul. Good talking to you, and good having you on the show this afternoon. Well, with that, we do have to take a very quick break. We'll come back, as always, get you a check on all the buzz from dealing rooms. So Nimesh is going to be with us for D Street Chatter, and then some final trading ideas coming up with Mitesh as well.